Hello, everyone, and thank you for joining today. I'm Phillip Nelson, and joining me is Jennifer Appel. And we're going to take the next 30 minutes or so and walk through kind of a quick hits on kind of what was some of the market action we saw last quarter. We'll spend a little time covering our market outlook and thoughts on inflation. And then we'll wrap up with some thoughts on positioning in portfolios and some more near-term adjustments to think about in portfolios for folks. Maybe kind of a first thing just to hit on a couple logistic items. The recording and a copy of these slides will be made available to all. Second, if you do have a question, please enter them into the question box in the top right, and we will get to everyone's questions when we wrap up our prepared comments. So with that, we're just going to get started and spend a couple minutes just talking about what do we see in the markets this last quarter. And I think one of the things that was pretty evident is across the board markets did well in the second quarter. Equities leading the way, but I think the thing that should be highlighted is the role interest rates played in that price movement. We saw rates, treasuries, and outside the US as well, all come in from, especially in the longer end of the rate curve, which obviously benefits fixed income, but clearly flowing through into kind of the momentum and market dynamics for equities, especially kind of the large cap growth equities that we see in the US. So US leading the way in terms of equities, again, largely because of companies that generate a lot of free cash flow maybe are benefiting from a lower discount rate. And you can see some of that in the dynamic here of looking at kind of growth versus value across the different regional indices from MSCI. I would say growth versus value is not a kind of binary implementation view that we really encourage. We think there's much more to kind of the equity complex than just thinking about growth versus value. But it is informative in terms of what did we see in terms of market dynamics and what did we see in terms of price action in the last quarter. And as you can see for Q2, growth clearly led the way, which was really a reversal from what we saw in the first quarter, where value did quite well as interest rates rose off the lows from 2019, and kind of hopes of kind of an economic resurgence really got priced into markets. And I think the piece that really would emphasize here as we think about these dynamics going forward, to what extent do interest rates play a role in some of this growth versus value debate and kind of dynamic. And I think the piece that we'd really encourage is focus more on kind of your active manager implementation. Focus more on how your managers are buying stocks and finding good quality companies, as opposed to should there be a large tilt to growth or a large tilt to value. I think something we've encouraged throughout the year is having a fairly balanced outlook in terms of growth versus value when it comes to positioning, and that's something that's likely to continue unless we see kind of real significant divergences, much more beyond what we've seen in the recent year or so between growth versus value. I think one thing that kind of reinforces some of these dynamics that we're seeing is we look at a kind of a sector view of the Russell 1000. We can see there's probably maybe three clear trends that kind of focus on. One is what we're seeing in the energy complex, where prices are recovering off, I think, the distressed lows that we saw last year. I think in many ways the energy complex has kind of emerged out of kind of a distressed pricing regime and is returning to a world of normalcy. And we'll have some thoughts on what that means for public real assets. But I think in some ways the price recovery is largely done, and now it's about cash flow generation and earnings generation for these companies. And I think the other dynamic to kind of point everyone to is thinking about technology sector versus financials. When we look at first quarter and second quarter performance with each of these sectors, you can basically see they're a mirror of one another. In the second quarter, technology did very well. First quarter, financials did very well. And in some ways, we can attach this to what are the embedded expectations for interest rates over the coming years. And I think one thing that I think many of us have talked about, and probably many of you have heard about, as we think about the equity complex, especially in the technology sector, the idea of free cash flow generation and the ability to discount that free cash flow at a lower interest rate benefits technology and names at the top of the S&P in terms of exposure, while financials benefit from likely a rising interest rate expectation. Some of that flows through into net interest margins, but some of this flows through kind of a normalization of rates benefits the financial complex. And so these are almost kind of the two disparate views that we're seeing in markets today. And we'll spend a couple minutes in the next couple slides just talking about kind of interest rate expectations that we're seeing. First, though, we just really wanted to really have a highlight to what we're seeing in earnings for S&P 500. As we look at calendar year earnings for 2021 and 2022, they largely recovered from their pre-COVID levels. And I think the piece to kind of emphasize is, should earnings outperform expectations, that likely will benefit the equity complex, whether it's in the US or outside the US. And I think one of the things that we're really cognizant of is when you look at S&P 500 or US equities, they're trading at above average valuations relative to history. But there's a rationale for why that's true. Should inflation stay within kind of a reasonable range, should interest rates stay low, should the Fed continue a fairly easy policy, should we see kind of continued fiscal stimulus from central governments? These are all kind of, let's say, tailwinds for why we think equities could continue to do well despite that valuation level. And I think one of the pieces that we're really thinking about in that equity complex, specific to the US and then specific to S&P 500 as well, is to what degree do profit margins play in that role? And so we think about profit margin levels today, they're near historic highs, but can they continue to move higher? And I think that's a real question that will, and factor that will drive performance, let's say, for equities over the next several years. Part of that kind of future view of equities, we can't disconnect interest rates from that. And as we think about what is the market's expectation for Fed funds over the next year or two, and also what's the expectation for what the Fed's likely to do in the coming years. And this is struck at this chart here is struck at the end of June, where expectation that almost guaranteed for a hike in 2022, and maybe 50% chance for 2 hikes. And what we've seen since in the last 27 days is those numbers really come in. And so as we think about growth expectations, inflation expectations, kind of market sentiment, that's really going to inform kind of, do we see Fed funds hike in 2022 or 2023? I think the piece that we try to focus on, rather than being kind of Fed funds predictors, is really thinking about what's the path likely to be. And I think our expectation is if we see a 1 hike at the end of 2022, the beginning of 2023, the difference of a couple months largely is not that important. But should we see, let's say, 2 Fed hikes in 2022, that would be a surprise and likely would flow through to kind of a fair amount of pricing disruption, both in the fixed income complex and the equity complex. That said, kind of our views overall is we think the Fed's likely to move slow, and we don't have an expectation that we'll see kind of big spikes in Fed funds over the next several years. And one of the things that just want to highlight also is what are we seeing in terms of kind of risk assets outside of the equity complex. I think one of the things we want to draw people's attention to is just what we're seeing in the credit space. And I think most specifically thinking about high yield and the spread levels that we're seeing across the kind of higher beta credit complexes. And we look at kind of where high yield is relative to history, we're getting closer to some of those lows. And I think one of the things we encourage people to think about is just setting expectations of what are you likely to see in the high yield space relative to returns in credit or returns in equities should kind of risk asset momentum continue. And I think we'd really encourage folks to maybe start dialing back or reducing some of that high yield exposure and finding other areas, specifically in equities, that may be a better risk adjusted return profile. And then lastly, just talking a little bit about kind of real assets. I mentioned earlier kind of the price recovery that we're seeing in the energy complex. This looks at it in a little bit more detail and similar profile that we saw in the first quarter. And I think the piece that we'd encourage people to think about is, as I think it's fair to say we've emerged out of kind of the distressed pricing levels across the energy complex and the real assets complex that we saw maybe a year ago. And as we've now done that, ask everyone to evaluate, what's the strategic purpose of public real assets in a portfolio? Is it an asset class that you're looking to rent as opposed to own? And if that's the case, maybe it doesn't fit in long-term objectives. However, for investors that do have kind of more inflation-sensitive needs, there may be a place for public real assets, and encourage people to kind of reaffirm that being the case. I think the other piece that we think about from an implementation view is, when we look at public real versus private, there's often better implementation opportunities that we see in the private real asset space. So with that, I'm going to turn it over to Jen to walk us through kind of a market outlook and provide some thoughts on the inflation environment.
Thanks, Phil. So as mentioned, I'm going to walk through our market outlook, and within this section, we're going to start by hitting on some of the main takeaways in our strategic outlook, but we also have dedicated a few extra slides to inflation to not only provide some context for the numbers that we're seeing, but also to provide an update on our forward-looking inflation views, since this has really been top of mind for so many investors. So with that, I'll start with our market outlook at a fairly high level. Many of you are likely familiar with our key market themes, and in particular, our permanent interventions theme. We continue to think that this is a really important theme in terms of how this influences the outlook for risk assets more broadly, but even more specifically, equities. And as a result of that support, to echo a lot of Phil's comments, we believe that equities can sustain above average valuations and profit margins, which leads us to encourage higher strategic equity targets for those that have the risk tolerance to do so. Aside from the valuation support that permanent interventions provides, the interest rate environment has also really dampened forward-looking returns across fixed income. So that return differential relative to what we're expecting for fixed income for equities is wide. So now, in conjunction with that higher strategic equity view, is our belief that safe haven fixed income has an important role in asset allocation. We have talked about this quite a bit over the last few years, but we continue to encourage a dedicated allocation to treasuries. And for more total return-oriented investors, we'd advise a 50-50 split between treasuries and TIPS. And this type of exposure not only provides portfolio liquidity, but it also provides downside protection in the event of market volatility. And so we do think that this is a necessary exposure across our client base, even despite low nominal and real yields. Then the last point, which we'll talk through in more detail, is surrounding inflation. This has been really the big story for the year thus far, but even with the changes we've seen in terms of market data, our longer term inflation outlook over the next 10 plus years is unchanged. What has changed is our expectations for the path of inflation over the next 1 or 3 years. So we anticipate that it will be volatile from an inflation standpoint, just especially given where annual inflation figures are today, since those are higher than what we expect to see consistently going forward. So with that being said, we'll walk through a few slides specifically on inflation to give some sense for the data points that we're kind of focused on and the ones that really inform our long-term views. So to start, we thought it would be helpful to provide some context for the inflation environments over the last few decades and show how that compares to what we've seen thus far in the 2020s. And right off the bat, you can see even with this meaningful uptick in inflation over the past few months, that the annualized number for this decade is roughly in line with what we saw for the 1990s. So putting it in this type of context where it appears we're on pace for something similar to the inflation of the 90s, now that doesn't really sound so bad. The 90s were not the 70s or even the 80s in terms of inflation, which is oftentimes where this inflation discussion turns given the uniqueness of each of those decades. And notably, I do want to mention that we omitted the 70s from this chart in part because the scale seems so crazy, but I call attention to that to say that we don't see anything in current inflation data to suggest that we're returning to the 70s or perhaps even the 80s for aggregate inflation. Now, one other important takeaway here is that as you look across these decades, the 2010s were an anomaly in terms of how low realized inflation metrics were over the decade. And so coming off of that, in some sense, kind of instills a recency bias where we've seen inflation data and expectations increase from a very low base. And so the recent numbers seem even more jarring than they would otherwise. But we tend to think that what we've seen in this decade so far isn't really out of line with expectations, especially when you account for the economic disruption associated with the pandemic and the economic impact that that's had. So flipping to the next slide, we've plotted a look through of the annual consumer price index, or CPI, in the US over the last year. And for those that frequently see our materials, we've been using this chart a lot recently, but I think it's really telling about the inflation environment. There's an obvious upward trend, which reflects the influence that the pandemics had in terms of deflationary price pressures throughout last year. But as the economy started reopening and in some sense normalizing, that has caused this uptick in 2021. And that's coupled with the upward pressures in energy prices we just heard about, and also supply chain disruptions from certain industries that are having a pretty big impact on these numbers. So to look at this in a slightly different way, we've delineated many of the price increases between that economic reopening theme, industries that are seeing supply chain disruptions, and then more broadly, core goods and services. And I think importantly here, the bigger than expected CPI prints over the past few months have been driven by just a few categories. And these are categories like used cars, airfare, hotels, among others. And these are areas that we believe upward price pressures are kind of to be expected following a lot of the deflationary pressures that they saw last year, and also that supply-demand imbalance that currently exists. And so as we look to this data, we're really trying to understand if continued price pressures are likely in these areas, or if this is more of a near-term issue. And so to tie this back to what I mentioned up front, our long-term inflation outlook's unchanged. We think that these cyclical price changes and supply-demand imbalances are pretty much par for the course as the economy emerges from the pandemic and transitions toward normalcy. That being said, we do see a greater upside potential for inflation now than just a few years ago, but keeping in mind that just a few years ago, realized inflation and inflation expectations were really low. So flipping to the last slide, we wanted to just give a sense for how much inflation expectations have actually changed, even over the course of the last year. Looking back to 2020, inflation expectations across the break-even curve were relatively flat, though upward sloping, which is reflective of a pretty normal environment. Then in Q1 of 2021, which is not on this chart, we saw a really dramatic upward move in inflation break-evens. And then more recently, the numbers have softened a bit from those highs. You can see that expectations are clearly higher across the board, though now we're kind of working with this inverted curve. So the market is clearly a little bit more concerned over the 2 or 3 year time horizon versus the long term. And that really echoes a lot of our thinking on the potential for elevated inflation prints and even inflation volatility over the near term, with the expectation that over the long term, we still end up at around 2.5% inflation. So with that, I'll turn it over to Phil to cover our thoughts on positioning in this type of environment.
Thanks, Jen. And we're going to spend a couple minutes just providing some brief comments on, what we'll call kind of near-term portfolio adjustments, and just kind of where we're seeing opportunities in the markets, and in some cases where we're, suggesting areas to be avoided or kind of shied away from across kind of global markets. I think the first piece to mention is when we think about equities, is when we think about kind of global equities, we're still favoring U.S. and emerging markets over EFI. EFI being kind of Japan and Europe largely, equities from there. That said, we are thinking about some of the recent price action we've seen out of China, specifically in the large cap public equities for China that have come under pressure with some of the recent rulings from the government there dealing with antitrust concerns. I would say we still have a kind of a favorable view of emerging markets and equities overall in Asia, but I think it's a good question for all of us to be thinking about. Is this a kind of one-time adjustment that we might see, or something kind of more permanent in place in terms of market pricing that we're seeing in mainland China. I think other piece to highlight, which we've alluded to, is just some of the recent action we're seeing in the credit space. And as I mentioned, credit spreads are kind of nearing historic lows, and we really encourage folks to kind of underweight kind of lower quality credit exposure, whether that's in high yield, multi-sector credit, or kind of other public market areas that have a high credit beta exposure. I think one of the things that we'd encourage is, while credit spreads, nearing, some of the lows that we've seen historically is a bearish signal for risk assets overall. I think some of the rationale for why equities could continue to do well, I think still holds, whether that's from Fed support, support from central governments, or kind of what we've labeled our permanent interventions theme, level of interest rates, potential for earnings to keep on moving higher. We think there's upside in equities to still be had, and think a position of reducing high yield and then taking those proceeds and pro rata moving it into a combo of U.S. equities and treasuries or safe haven, we think is a better risk-adjusted return profile that allows for some of the safety to come through from the treasury complex, but also allows for that upside from equities. Especially compared to maybe the more limited upside we might see from the high yield credit complex. And so just have a couple other things to highlight in regards to that credit view. I think one of the things to really focus in on is market pricing of CCC rated debt. And I think we've seen credit spreads move quite a bit for CCCs in the last 18 months. What we've seen most recently, and this is still holds true, is CCCs have moved below 500 basis points in terms of spread levels, which is really a rarely seen level for CCCs. There's very few instances where we've seen this through history, but typically being, they don't move too far lower from these levels. And so this just kind of reinforces our thought that credit markets are flashing some warning signs in terms of directionally where spreads can go from here. And I think this is one to clearly be mindful of for investors. And with that in mind, you can really see how we've tried to look at what's the potential of, in this example we used high yield. When high yield spreads for high yield broadly are trading below 300 basis points or 400 basis points for credit spreads, how does the market tend to do kind of 12 months thereafter? And so when we look at high yield, historically when spreads are below 300 basis points, which is where we're at today, fairly limited upside. And so thinking about moving some of that capital to a combination of U.S. equities and safe haven fixed income, we think offers a better return opportunity going forward. Now, historically, this would suggest a more defensive posture because, frankly, when spreads are below 300 basis points, the safe fixed income has actually been the better return source. But I think we've not reached a point where we want to turn to a kind of more bearish outlook, even considering the strong gains we've seen in the equity complex. So having something that's a combination of a little defensiveness from safe haven and treasuries, but still being focused on a little offense with U.S. equities, we think makes a lot of sense. And I think the piece I would say, this is all relative to what your target equity exposure is. So, for folks that are at a 50% or 60% equity target, think about positioning relative to that starting point with our comments. So with that, we want to be kind of efficient with everyone's time and take a few moments to ask folks, ask some questions. Maybe to get started, send question over to Jen related to inflation and what would cause us to be concerned or kind of change our view in terms of our inflation outlook from what we're seeing today.
Yeah, thanks for the question. There are a couple things that come to mind, and this is something that our team has spent a lot of time thinking through. So maybe to start, I talked a little bit about market break-even inflation expectations, which in the chart we showed it ranged from 3-ish percentage points on the front end of the curve to about 2% or 2.5% on the long term. So we frequently look to not only market break-evens, but other inflation expectation metrics to get a sense for not only what the market's expecting, but also businesses and consumers. So a big change or upward move in those would definitely be concerning. That's a pretty clear sign that the market kind of starts believing and expecting inflation to happen. And in some sense, that can be self-fulfilling, particularly if consumers start to adjust spending habits as a result of potential loss of purchasing power. Beyond that, I mentioned a bit about supply constraints that were causing some inflationary pressures. So to the extent that we start to see more supply issues that are widespread, not just in chips or used cars, for example, that could certainly start to impact a wider portion of the CPI basket and impact some of those more core goods and services. And then lastly, I think it's worth mentioning, I kind of left the Fed out of some of my earlier remarks, but the Fed has stated their willingness to let inflation run above target for some time to make up for the persistently below target inflation that we've experienced. So there's really an outstanding question of the timeline. If we continue to see CPI prints in the 5% range, really like how long will it take the Fed to act? So as part of that, there's certainly a risk that the Fed either is too slow or too quick to act, both of which can impact inflation and cause us to become more concerned.
Thanks, Jen. One other question that came in is related to high yield and my comments on kind of underweighting high yield. And the question came in, should we hold any high yield or kind of high beta credit exposure? And I think the simple answer is we do think you should hold some high yield exposure, and largely we encourage folks to have active managers provide the implementation for this space, and so we think reducing it makes sense, but there will be a time where spreads rise. History teaches that at some point spreads will normalize, and when they do, it tends to be a fairly disruptive and quick process. And so if spreads are 1,000 over, 800 over, that's generally a good time to be buying high yield, and you want to have positions in place to be able to reallocate funds quickly into that area. So again, we don't think this is a wholesale elimination of high yield credit, and frankly, some may have some really high conviction managers where they have a high confidence in the alpha, which if you believe strongly in your alpha profile from your manager, that may overweight some of the beta concerns that we've expressed related to that asset class. Another question we'll toss to Jen here is, do you have any thoughts about actions one might take related to managing kind of a real return profile if you're essentially trying to defend real returns versus nominal returns, especially in an environment where we may see some currency weakness?
Yeah, I think there's an interesting opportunity for real assets to play a role if you're specifically concerned about maintaining real returns. So real assets, can be challenging just because from a risk return standpoint, historically, they haven't provided exactly the most attractive return. So going forward, especially if we're anticipating greater inflation, that could be an interesting way to get more inflation sensitivity into a portfolio. And then from the currency standpoint, we recently released a series called Topic Talks where we cover the US dollar specifically, and we go through a lot of the details behind the dollar's reserve currency status, with the main takeaway being that the US has benefited quite a bit from that status. So it can be challenging for that status to lose pace over time, in the sense that most of the financial infrastructure is kind of built around the dollar. So we don't see dollar weakness necessarily coming in the coming years, but it is difficult to predict that kind of stuff.
Thank you, Jen. And that is the questions that we received, and really want to thank everybody for their time today. We know everyone's busy, and especially in these summer months, we wanted to be efficient with everyone's time. And just as I said, we will make the slides available, recording available for those that would like to review after the fact. And want to thank everybody for the time on behalf of Jen and myself. Hope everyone has a great rest of the summer, and feel free to reach out if you have any questions. Thank you all.